Welcome to This Explainer. I am absolutely thrilled to have you here today because, look, we are taking on a topic that is just completely saturated with noise, hype, and illusions. I mean, if you spend any time online lately, you have definitely seen the flashy, get-rich-quick trading ads, right? The luxury cars, the magical weekend courses, the promise that you're going to be swimming in overnight wealth. Well, today we are stripping all of those scams away. We're looking at the actual, grounded reality of what it really takes to become a consistently profitable trader.
To guide us through this, we're relying on a phenomenal masterclass from seasoned investor and trader Jason Greystone. He hits the nail on the head here, saying, "There's so many educators and fake gurus and scams trying to take your money. I'm going to give everything away for free, directionally correct, so that you get there as quickly as possible without all the fluff." And you know what? That is exactly our mission today. We are compressing hours of comprehensive, completely hype-free trading methodology into a highly structured roadmap.
So to kick things off, let's just deliver a massive reality check. 18, specifically 12 to 18 months. That is a realistic timeline of dedicated, focused practice required to become a consistently profitable trader. It completely shatters that whole myth that you can just buy a weekend course and start printing money on Monday morning. Trading is a lifelong financial skill. Just like learning a complex instrument, it demands a genuine, serious time commitment.
Okay, let's dive right into our syllabus for today. We've got 5 parts. 1. The trading reality check. 2. Reading market language. 3. Riding market waves. 4. Placing your orders. And 5. The blueprint for success. We're going to move logically from getting our mindset right all the way through to executing and back-testing our edge.
Let's jump into phase 1, the trading reality check. Setting expectations and managing risk. Because before we even think about looking at a single chart, we absolutely have to prepare our minds and protect our bankrolls.
So what does that 18-month journey actually look like in practice? Well, it's broken down into some really clear phases. The first 6 months, that's just for learning the core concepts and mastering them mentally. Then, at the 12-month mark, you're deep into demo trading. That means using fake money to test and tweak your systems. You might be wondering, why a whole year? Well, because you literally need to experience all market conditions. You need to trade through different holidays, wild economic news events, and seasonal shifts. It's really only around the 18-month mark that you've done enough fine-tuning to confidently step up and trade live capital.
Which brings us to the ultimate golden rule of risk management, 1%. You should never ever risk more than 1% of your total account on any given trade. If you have a $10,000 account, you risk $100, period. This is literally how you survive the learning curve. And frankly, while it might sound small at first, remember the context here. A traditional bank might pay you a 1% or 2% return across an entire year.
Moving right along to section 2, reading market language, the anatomy of a candlestick. Let's dig into the actual visual tools that traders use to read price action.
Every single chart you look at is going to be built on this one core concept, OHLC. Open, high, low, and close. These are the 4 essential price points that make up a single candlestick over a specific time period. Whether that candle represents 1 hour of trading or an entire day of trading, these 4 data points tell a distinct, immediate story about exactly what happened during that session.
Let's contrast the 2 basic outcomes you're going to see. A bullish or green candle simply means the price closed higher than it opened. A bearish or red candle means the price closed lower than it opened. A green bullish candle or a red bearish candle tells you exactly who closed the session in control. Now, I know it sounds incredibly simple, right? Yet rookie mistakes happen every single day because a trader fails to just step back and honestly identify who is actually dominating the market.
But look, it's not always a clean victory. You constantly have to ask yourself, who won the tug of war? This introduces the concept of candlestick wicks, those thin lines extending from the top or bottom of the candle's body. A long wick shows you exactly where one side tried to aggressively push the price, but was forcefully rejected and slapped right back down by the other side. Reading these rejections is exactly how you predict where the market is likely heading next.
All right, let's step back and see how this all builds in section 3, riding market waves, identifying trends and structure. We are zooming out to look at the broader waves of the market.
When you zoom out, you'll find the market is generally in one of 4 conditions. It's bullish, moving upward. It's bearish, moving downward. It's ranging, meaning it's moving sideways, kind of bouncing between clear horizontal ceilings and floors. Or it's choppy. Choppy is erratic, indecisive, and honestly, just ugly. So the absolute crucial takeaway here is, if you see a chalky market, walk away. There is no clear edge for you there. You should only trade when the structure is clear.
And when that structure is clear, specifically in a trend, it dances to a very distinct rhythm. Step 1 is the run. That's the big extension in the direction of the trend. Step 2 is the pullback, a temporary retracement against the trend. And step 3 is the check, watching closely to see if the ceiling from the previous run has now become a solid floor to support the next move. Listen to this. Rookies rush in and buy during step 1 out of pure FOMO. Professionals, they patiently wait with their cash to buy it at a discount on step 2.
So, you've analyzed the chart. You've found your setup. What next? Section 4. Placing your orders. The mechanics of execution. This is the combat phase. Because, let's be real, all of your brilliant chart analysis means absolutely nothing if you don't know how to instruct your broker to execute your plan.
First, we have to internalize this profound truth. Every order is an order. I know it sounds a bit repetitive, but it is so essential. The market does not care about your specific trade plan. Your entry price could be the exact spot someone else is placing their stop loss. Your profit target might be someone else's starting line. You have to put just as much care, precision, and strategy into placing your exit orders as you do your entry orders.
To do that effectively, you need to speak the broker's language. Let's contrast the two vital order types. A limit order is basically an instruction to get you in at a better price than the current market value. Think of it like setting a trap to catch that step 2 pullback we just talked about. A stop order, on the other hand, is an instruction to get you in once momentum pushes through a certain level. This is highly effective when setting a stop loss to protect your capital if the market suddenly crashes through your safety net. Ultimately, they're just automated instructions, so you don't have to sit there staring at a screen 24/7.
When you place these instructions, you absolutely must follow this ironclad order sequence. Step 1. Set your entry order. Step 2. Immediately set your stop loss order so you have an automated exit if you're wrong. Step 3. Set your target order to take profits. This sequence is completely non-negotiable. You must mathematically accept exactly where you are wrong in step 2 before you ever even dream of taking profits in step 3.
Which leads us perfectly into our final phase, Section 5, the blueprint for success, testing, and mathematical edge. Honestly, this is my absolute favorite part, because this is where trading stops being a stressful guessing game and transforms into a predictable, manageable business.
I absolutely love this mindset shift from our source material. Think of trading as a business. Your sales are your winning trades. Your overheads are your broker fees and your losing trades. Think about it. When a restaurant throws away spoiled food, they don't cry about it, they just write it off as an expected overhead expense. As a trader, taking a loss is not a personal failure. It is simply an expected business expense.
And how do you know if your business is actually viable? Well, you calculate your positive expectancy. Here are the variables you need. P is your strike rate, or basically how often you win. Let's say it's 55% of the time. W is your average win amount, say $200. And L is your average loss amount. Let's call it $170. You run these historical numbers through an expectancy formula, and as long as the final calculation sits above 0, congratulations, you have a mathematically profitable business model.
But here's the catch. You don't find those numbers by just guessing. You find them by doing the work. Here is your demo testing checklist. First, test one currency pair completely before jumping to others. Log your exact entry and exit dates. Note the specific market condition and the trend phase you traded in. Record any candlestick rejections or deceleration patterns. And finally, calculate that positive expectancy over a massive sample size. This zero-risk demo account practice is literally how you build absolute, unwavering confidence in your edge.
So we end today right back where we started, with a fundamental choice. Are you ready to stop chasing the illusion of overnight riches? Are you ready to reject the fake gurus, sit down, and dedicate the next 18 months to mastering a lifelong financial skill? The roadmap is right here in front of you. The rest? Well, that's entirely up to your dedication. Thanks so much for joining me on this explainer. And hey, happy testing!